All right, let's get right into it. In this explainer, we're going to completely reframe how you see the market. We're going to toss out that old retail playbook and dive deep into the institutional mindset, the actual framework that dictates how price is really delivered.
So let me ask you this. Does this sound familiar? You find a perfect setup, you place your trade, you set your stop loss right where all the textbooks tell you to, and then boom, price just spears down, hits your stop to the tick, takes you out, and then immediately reverses and skyrockets in the direction you wanted it to go. I mean, it feels personal, right? Like they're hunting for you specifically? Well, the thing is, it's not bad luck, and it's not random. It's all by design.
To really get why that happens, you have to accept one fundamental truth. The market isn't some big, fair playground. It's a battleground, and there are two very different sides. You've got the smart money. We're talking the big banks, the institutions, the ones who are actually in control. And then you've got the uninformed money, which, let's be real, is where most retail traders are.
Now this is the idea that changes absolutely everything. The price action you're watching on your charts isn't the organic result of millions of buyers and sellers. No way. It is an engineered process. Think of it as a highly sophisticated algorithm designed by institutions for one reason: to help them fill their own massive orders efficiently. They're the ones driving the car. Everyone else is just along for the ride.
And just look at this breakdown. It's like night and day. The retail mindset is all about chasing profits, following the latest guru on social media, and stacking up a bunch of lagging indicators. It's loud. The institutional mindset, though, it's the complete opposite. It's quiet, it's surgical, and it is laser-focused on one thing and one thing only: liquidity. They don't need indicators because they are the market. They don't provide liquidity, they hunt for it. So, here's the most crucial part. If you want to start seeing the market for what it truly is, you have to consciously unlearn all the myths that keep 90% of traders trapped in a losing cycle. It's a complete paradigm shift. You have to tune out all that retail noise and start listening for the institutional signal. Let's just tear these apart right now, shall we? Retail volume moving the market? Come on, that's a drop in the ocean. Indicators predicting price? They're just a reflection of what already happened. They're always a step behind what smart money did 5 candles ago. And those beautiful clean trend lines? They're not support or resistance, they're just targets. They are engineered to make you place your stops exactly where the institutions need them to be. This quote really just says it all, doesn't it? The market is a ruthlessly efficient machine, but let's be clear, it was built for the banks, not for you. So at every single moment, you've got a choice. You can either be the fuel for their engine, the liquidity they need to fill their orders, or you can learn to think like them and hunt right alongside them. There is no middle ground.
So, if we're gonna hunt with them, we've got to use their tools. Let's break down the 3 core building blocks that smart money uses to read the true story the market is telling us.
First up is the order block, and you can forget about simple support and resistance. An order block is like a footprint in the sand. It's a very specific price candle that shows you exactly where institutions have injected a massive amount of volume. The market algorithm is literally programmed to remember these levels, and it will often drive price back to them with surgical precision to rebalance positions before the next big move. Next, we have the fair value gap. You know, when price moves super fast and aggressively in one direction, it leaves behind an inefficiency, a literal gap in the market. Well, the algorithm hates that. It sees it as an imbalance that has to be corrected. So price will almost always be drawn back into these gaps, like a magnet, to rebalance price delivery before it continues its move. And finally, we get to the fuel itself, liquidity pools. Every single obvious high and low you see on your chart, what do you think is resting just above or below it? A huge cluster of stop-loss orders. That's a giant pool of liquidity. The market algorithm is designed specifically to seek out these pools, trigger all those stops, and inject the orders into the market that institutions need to fill their huge positions. Now, here's the kicker. These concepts, order blocks, fair value gaps, liquidity pools, they don't just happen randomly. They're all embedded within a predictable, repeating 24-hour cycle. Understanding this daily blueprint is like having a map of where the market is likely to go, and more importantly, why. Think of it like a 4-act play that repeats every single day. Act 1 is the Asian session. It's quiet, it consolidates, and it's just building up liquidity. Buy stops and sell stops above and below a tight range. Then comes Act 2, the manipulation, a false move often called the Judas swing. It's engineered to trap breakout traders on the wrong side.
Act 3, the London session, uses that trap as fuel. It runs the stops, grabs all that liquidity, and establishes the real higher low of the day. And finally, Act 4, the New York session, which is typically the expansion, continuing that main directional move. So what we're really talking about here is an algorithm, a predictable sequence with very firm rules. This isn't about guessing anymore. It's about understanding the logic, the code that drives price delivery.
You know, at its heart, this algorithm really only has 3 states. It's either in consolidation, where it's building up energy and orders, or it's in expansion, releasing all that energy in a big directional move. And after that expansion, it can only do one of 2 things. It can either retrace or reverse. That's it. This simple sequence governs everything, on every single time frame.
And that leads us to some unbreakable rules of the game. A market that's consolidating will never just start retracing or reversing out of thin air. It must expand first. All that energy that's been built up has to be released. Understanding this one simple foundational rule will keep you out of so many bad trades and give you a clear framework for what's likely to happen next.
So the ultimate goal here, it's not about catching every single pip. It's not about having a perfect win rate. True mastery in this game comes from internalizing this predictable model and just executing on it with discipline, day in and day out. It's all about process over profits and patience over impulse. So we'll end with this. You now have a glimpse into the blueprint, the real rules of the game. You've seen how the market is engineered and why it moves the way it does. So the only question left is, what are you going to do with this knowledge? Are you going to continue being the fuel for the engine, or are you going to start thinking like the engine? The choice is yours.